Here to discuss the future of the IPO market is John Tuttle, Vice Chairman and Chief Commercial Officer at New York Stock Exchange. So, John, let me ask you, what's driving the growth in the IPO market and which industries are taking the lead?
Well, great to be with you. It certainly has been an exciting quarter, an exciting year for the IPO market. So what's driving it is your question. There's several things. Number one is interest rates are low and relatively stable. So as institutional investors are looking for asset classes to allocate capital, one of the ones that they're seeing the most meaningful return from are equities or stocks. Number two is the indexes continue to flirt with their record highs, which means that as these companies go public, the companies they're comparing themselves to, their public comps, are trading high. So they're going to receive a warm valuation when they come to market. And the third thing is those companies that have gone public have received a very warm welcome, generally speaking, from investors in the days, weeks, and months following their listings. So where are these deals coming from? They're coming from several areas. Number one is technology continues to lead the way. Number two is healthcare. And number three is consumer. And consumer is a big change from previous years because that's really driven by people hoping we're at the final stages of this pandemic and going out and acquiring goods, making trips, seeing friends. So we welcomed great companies like Weber Grills, Traeger Grills, and even Warby Parker this past week for their direct listing. And as we look out, we're going to see those sectors going forward. But also one that I would flag as well is clean tech. Because when we look more broadly at the market and sectors like auto shifting to mobility with the electrification of their fleets and autonomous vehicle features, or if we look at energy companies and utility companies that are transitioning into solar, wind, and other renewables, this doesn't happen on their own. There's a lot of exciting entrepreneurs and companies that are going to need to be there to help aid that transition, and those are the type of companies that you're going to see coming to the markets.
Now, historically, John, companies enter the public market through an IPO. However, in the second half of this year, there has been an uptick in SPACs and direct listings. You mentioned Warby Parker being a recent example. So why are companies choosing these alternative routes?
Companies can now go public for different reasons. So there was one path that they would go, and that was the IPO, and they would raise capital and come to market. But we said to ourselves, can we create more products or help develop other products that may be tailored to meet companies with differing objectives, meaning they don't necessarily need to raise capital at the time of their listing, but they want the other benefits of being a publicly traded company. So a share currency for M&A, liquidity for their employees and for their investors, or even the branding that comes along with being listed on the New York Stock Exchange. So we work to create more pathways to the public markets with the direct listing, the primary direct listing, the SPAC, and of course the IPO, and even innovation within each one of those verticals. So now companies have more options, and that's something we're really excited about.
All right, so since 2000, over $1.3 trillion in value has transferred to the New York Stock Exchange from NASDAQ in the equity market cap. So why are companies moving from the NASDAQ to NYSE?
Well, companies value different things. If companies value better trading and better market quality, which helps lower their costs for their investors and their own company's cost of capital, or if they're focused on growth, they're making their way to the New York Stock Exchange. When I say focus on growth, I think of this incredible community of companies we have here. It's 2,400 companies from around the world. They're worth over $40 trillion worth of market capitalization. But what I think is most interesting and exciting to companies that are listing here is that these companies employ 43 million people directly and multiples more indirectly. And over 80% of public company IT spend is done by NYSE listed companies. So for those companies that are focused on growth, they're making their way here to the New York Stock Exchange.
And we've spoken to a few venture capitalists about the concern over a proposed federal tax legislation that would reduce the QSBS exemption. So which impacts the investment in early stage startups going to public markets? Is there a disadvantage to companies going public later in its life cycle? And how could this reduced tax exemption change the IPO landscape?
So selfishly speaking, we encourage companies to go public as early as possible in their life cycle. Of course, we want them listed here on the New York Stock Exchange, but also a big part of that value creation comes after a company goes public. That's when they do the most hiring, that's when they do the most investing, and that's where you really see the most returns come for investors. And that's institutional investors or individual investors who may be saving for their children's college fund or their own retirement. So if companies can come to the public markets, we need to make sure we have policies that are in place to warmly welcome them and encourage that.
So what kind of policies have been changed to add more people to come to welcome them, and what policies have been taken away to make that pathway a little more clear?
Well, so, the work that's been done at the SEC over the past few years is encouraging. And the SEC obviously has its job and main mission to uphold investor protections, but they're also focused on capital formation. And so we were able to work closely with the SEC in defining those new pathways to the public markets that may be better suited for a company's objectives as they go public, and also their investors' objectives as they go public. So just making sure that our public policies, whether they be on Capitol Hill or at the SEC or elsewhere, continue to evolve to meet the demands of the marketplace and companies.
So what is your expectations when it comes to IPOs next year?
So we continue to see a robust pipeline of companies, at least through the first half of 2022. Market conditions continue to be welcoming to companies, but obviously we want to make sure that the market can absorb all these companies. They have thus far, and if there is too much supply and too limited demand, the markets will easily correct for that. But as we look out into 2022, we see an exciting pipeline of companies from healthcare, from technology, from clean tech, from consumer, but also from outside our borders. So Latin America is going to be an exciting area that you're going to see companies listing in the United States, also parts of Europe and other parts of Southeast Asia.
All right, John Tuttle, Vice Chairman and Chief Commercial Officer at New York Stock Exchange. John, thank you so much for joining us on the show. It's a pleasure to see you.